Hi, welcome to the channel. My name is Dave, and today I want to do a simple presentation on writing or selling in-the-money call options. I want to do this because I get lots of questions on this topic, and if you're new to options, it can be very confusing. Now, if this does help you, please like and subscribe to the channel. It would really help me out. Now, let's start with the topic of in the money and out of the money. So for a call option to be in the money, the stock price should be above the strike price. For it to be out of the money, the stock price simply needs to be below the strike price. That's simple enough to understand, right? But for puts, the opposite is true. So it is in the money once it goes below the strike price, and it's out of the money when it's above the strike price. So the more you use options, the more this will become clear, but it's an important starting point for us. The reason I want to cover this topic is because I get lots of questions such as, why is it okay to sell in the money call options? Pretty blunt, pretty straightforward. Or, why is buying a stock and offering to sell it for less using a call option perfectly fine? Or, why are in-the-money call options not immediately exercised, right? Somebody thinks they've figured it out, right? They're just going to buy call options, immediately exercise them, make a bunch of money. But they just haven't followed the math through. So these are the type of questions I get, and I want to give you some answers today. Now, I like a good analogy, so I went with the stock market is the Earth. And what rotates around the Earth? It's the moon, and that's the options market. So they are linked. They rotate around each other. They're linked together by strike price, expiration date, the underlying security, but they're also separate in the sense that on Earth, you can buy and sell stocks, whereas on the moon, you can buy and sell options. Now, for example, we're going to use world-famous stock XYZ, which is trading at $100 a share. You can buy this stock here on the Earth. But we can also zoom out to the moon and we can sell options or write options or buy options. So out here we're going to sell, we decide, an in-the-money $95 call, which is below the stock price of $100 right now. That's simple enough. And if we summarize all this information, we find out we got stock XYZ at 100, and we're going to sell a 30-day expiration $95 in-the-money call. And when we do that, we get to collect this special thing called a premium. That premium, in our example, is going to be $580. Now, it is important to understand that as a seller or writer of options, you're giving the right to the buyer to fly back to Earth whenever they would like. That's a one-way ticket. That contract is a one-way ticket back to Earth. They can take assignment of those shares whenever they would like. We'll talk more about that. But as the seller, you're stranded. You're stuck out here on the moon. You can always close out your position, buy to close, but you can't fly back to Earth like the buyer can. Also, it's important to understand that when you write or sell an options contract like this and you collect that premium, it's due right now. You receive that at $580 right now. And if you are the buyer, you have to pay $580 right now. So sitting out here on the moon, we look pretty good, right? We have an options value of $580. Whether you're the buyer or seller, that's the value of the option. But back on Earth, if we look back over there, it has an exercise value, right? It follows the stock market. Back there, it's worth only $500. So we don't want to go back there. We don't want to go back there. If we own this option, we would rather leave it out here on the moon where it's worth more. Now, why would we go back there? Well, if we really want to take assignment of the shares, we could do that. We can go back to Earth. We can execute our contract because we have that right as the owners of the option if we're the buyer. And we can take assignment. Let's work through the math, right? So we have a stock price of 100. We've got a strike price of 95, which means this has $5 of built-in value. And we call that intrinsic value. If we take that times the number of contracts we have, which is 1 in this case, one contract is worth 100 shares, we get a $500 value back there on Earth. So we certainly don't want to go take assignment right now, would we? We want to stay out here on the moon, whether it's in the money or not, because it has a higher value. We'll talk about why that is here in a minute. Now, the other situation where we'll have to fly back to the stock market back there to Earth is at expiration. And at expiration, it's only going to be that intrinsic value, built-in value. The math is exactly the same. Whatever's built into that option, that's what it's going to be worth. Simple enough. Now, if you sell an options contract, you're stuck here on the moon. You don't have the right to go back to Earth. Only the buyer has that right to go back there and exercise this contract. But they don't want to. They want to stay out here on the moon because it's worth more, right? Staying on the moon is worth more. And what makes it worth more is what we call time value or extrinsic value. And that's very easy to calculate. We can take the options value that it's worth out there on the moon and subtract what it's worth there on the Earth and get $80. So 580 minus 500 gives us $80 of time value. So $80 ticking away till expiration. So if we want to break this down now, we've got two different values. One, intrinsic value or IV of $500 with it at a $100 price. And in time value of $80 gives us our total $580. So as time ticks away and expiration approaches, time value heads towards zero. Until finally, eventually, at expiration, the Earth, the Moon, everything is just intrinsic value. So until that point, it really doesn't matter. Till that point, we have time value. So stay out there on the moon and use that. You would sell that option for just a little bit more if you're the owner versus going back to Earth. So we have two markets. We have the stock market and we have the options market. And the options market derives its value from the stock market, but it is separate. So just keep that in mind. Bottom line, it is better to buy or sell an in-the-money or out-of-the-money option because it is worth more compared to exercising. And that's simply due to time value. There's always going to be time value till expiration. So stay on the moon and take advantage of that time value. Now, there are exceptions to this, and we need to talk about that real quick. And those are dividend X dates and deep in-the-money options with little time value. These options, we'll have to watch a little bit closer because there's a higher likelihood of those being exercised. For more information on that, please like and subscribe. Thanks so much for watching. Have a great night. Take care.